Yeah, so for the last few weeks, we've been, or months maybe now, we've been reasonably upbeat. The support that was given to the market in March seemed sufficient to us, and we've been in the, I suppose you'd call it the bullish camp since then, and allocated more to equities, still more to very high quality equities across Europe and the US, but that's done very well. And we're in a sort of a slight holding pattern now, it seems, while we're trying to get the data. We're opening up a bit more, as we've seen in the UK. So really, we're not doing a lot in the portfolio. We haven't really made any changes in the last few weeks or months, month and a half maybe. So we're kind of in a holding pattern. I think Steve referred to it as half time earlier, and one doesn't really know how the second half's going to play out. I am cautiously optimistic that as we open up, we're going to see pent-up demand from all of the savings rate increases, the high cash levels across consumer, household and government balance sheets and corporate balance sheets. Now they've issued so much debt. And I think we will see a potential, sharp rise in consumer demand across Europe. And then we have to see where that levels out. Does it level out at +5, -10? And we're not quite sure yet. And it's why looking at the economic data coming out this morning is so important.
One thing that just screams to me from your fund at the moment, Freddie, is the amount you've allocated to inflation-linked bonds, 28%. I'm looking at the May note. I don't know whether that's changed as you've moved into June now, but that is a huge bet, it seems, on how all this liquidity eventually manifests itself in inflation. But what will be the driver structurally of that inflation?
So I don't really know what the driver of that inflation will be, and that's the key question. But if you take one step back, I think if you start off with a clean sheet of paper, what are you going to invest in today? Cash seems like the least attractive opportunity for long-term investors. So you have to be looking into asset classes. Buying bonds globally yielding very, very close to zero, with the clear threat from fiscal and monetary easing that they are trying everything to push for inflation. I think it is far more intelligent to only allocate to inflation-linked bonds at this point, where you get a small yield, a small nominal yield, possibly even a negative real yield today, but that may be more attractive than the implied negative real yield at zero rates across the conventional curve. So we're only investing in those inflation-linked bonds. We still have nearly 30% in the fund. In terms of where inflation comes from, I don't know. I'm not a huge inflationist, but the great thing about these things is that they trade on inflation expectations. And I feel very confident that as and when we do open up the economies and we see this demand coming, we will see pockets of localized inflation from an old-fashioned sort of demand pull inflation basis. As people have more money in their bank accounts, these stimulus checks are still there sitting in cash or stocks now through the Robinhood accounts. They will be spent on goods, and we will see pockets of supply chain disruption. We will see pockets of inflation coming through, and I anticipate that will lead to higher than the very, very low inflation expectations priced into these bonds at the moment.